All right, today we're going to be talking about different forms of mortgage fraud and how somebody may or may not be intentionally committing mortgage fraud. Hey guys, my name is Andrew Augustiniak, and I am the team leader and owner of the Augustiniak Lending Team. Our team lends over 45 different states, so just a reminder, you can click in my bio, contact me directly. But mortgage fraud is one of those things that some people try to do, which you shouldn't try to ever commit mortgage fraud, and then some people unintentionally do it. So mortgage fraud, a common type of mortgage fraud is honestly, and the most common is occupancy fraud. Now, a lot of people try to commit occupancy fraud, and we as lenders do our due diligence to prevent it. But occupancy fraud is really just buying a home under the assumption that you are saying that you're going to use it for one type of occupancy and then using it for another. So the most common, honestly, is an investor buying a home as a primary home and never actually living in it. They're buying it as a primary home to either put the least amount of money down and get a better interest rate to ultimately rent that out and generate income from it. Now, occupancy fraud is the number one form of fraud where people can do that intentionally, but I'm going to tell you how somebody may do it unintentionally. Unintentionally would be if I'm buying a home as a primary property, I'm signing disclosures that say I'm going to occupy that residence within 60 days and live in it for at least a year, 60 days. So unintentionally would be like somebody who's buying it as a primary home, but they're not planning on living it for 120 days. And they just don't tell the lender that they don't plan on moving in for at least 120 days. Well, that's an unintentional form of fraud and it shouldn't happen. And so the point of this whole video is to understand that you, to your lender, you want to be as transparent as possible, give them all the information as possible. So they, us, whoever you're using, can help make sure that your loan is structured so you are not committing any form of fraud, whether it's occupancy, whether it's down payment, telling your lender your down payment's coming from one place, but it's actually coming from another, or employment. Let's say a good example of that would be somebody losing their job, on the day of closing, and they lost their job after this has actually happened before. We're on closing day. We've already done our final verification of employment, but then in between closing and when we did our final verification of employment, they actually get fired. We close on the house and the borrower actually lost their job and we don't know about it. In that situation, that borrower should have told the lender, hey, I got fired. I can't close on this house. It's not right. It's an intentional and an unintentional form of fraud, because to a borrower, they're like, hey, they already did my final verification, I can close. When in reality, they should be always transparent. You should always be transparent with your lender. Tell them all the debts that you have. An unintentional form of fraud could be not disclosing all of your monthly debt obligations to your lender. The lender needs to know what you need to pay on a monthly basis versus what your income is. So not telling them what you're paying on a monthly basis, not telling them any debts that may not show up on credit, things like that. So guys, the biggest takeaway from this video is be transparent. Tell your lender the information so they can make sure your loan is structured properly so you are not at risk for any form of loan fraud with your particular mortgage. If you have any questions, guys, my name is Andrew Augustiniak. Reach out to me. I'd love to help you. I'd love to have my team help you. We're in many different states, and we'll catch you on our next video.